So we're seeing strong growth in a business that's actually been substantially discounted since the merger did not go through here. Welcome back in YouTube. Today I'm actually going to dive into an interesting deal. If you guys are not familiar with it, Kroger was trying to acquire Albertson, which now looks like the deal could be dead, but they're still fighting through litigation to possibly get the deal done. And I am interested in Kroger, but what I decided to do today was take a look at the arbitrage deal and kind of the floor that's in Albertsons, as I do think this is more interesting from the Albertson side on the short term and more interesting on the longer term Kroger as far as an investment goes. So let's dive into this deal, as I just wanted to kind of put a video out today and go over this with you. So hopefully you guys enjoy, and let's get into it. First thing I want to do here is actually just look at the 1-year price action in Albertson. It has a 52-week range of roughly $19 and $30. Does pay a 2.2% dividend. As we see here, Kroger-Albertson deal faces a long road ahead for approval. And so I'm going to give you guys my thought process here, as I would rather own Kroger long term, but this deal could still possibly go through. And as we see, when this news was originally hitting, Albertson was trading around $28, almost $29 a share, currently trading around $21 a share and as low as $19, as I stated before. And I think it does get interesting in the teens here, and I'm going to break that down in a second. But the initial deal was Kroger was going to buy Albertsons for roughly $34.10 a share. Now let's go take a look at what Albertsons has done over the last few years. When we look at Albertsons overall, definitely trades for a discount here. PE of roughly 9, and I believe the forward PE is between 7 and 8. So single digit PE here. And there is reasons why it does trade below its peers' valuations. So when we take a look at the financials, it only has a $12 billion market cap. And this is a company that has had good top line growth, going from $62 billion all the way up to $76 billion in top line revenue. A little bit more about Albertsons companies here. We can see they have Safeway, Vons, Acme, Shaw's, and I'm familiar with Shaw's. I believe that's a New England grocery. And so when we think about Albertsons, we can see here that there are many different grocery stores underneath that brand. Once again, taking a quick look at top line revenue growth, nothing extremely impressive, but steady growth, especially when we factor in the pandemic here. And, that's something we really have to consider, is basically through 2020 and beyond, it really had an acceleration in revenue growth. So we want to remember that and put that on the back burner, as I do think we'll see revenue growth decelerate here. When we compare Albertsons to its peers, the reason why it trades at a significant discount is the fact that the margins are not great in their business, and their free cash flow is a little bit weak as well, but they do have free cash flow. And I do think that at the right price, this becomes an interesting company, and there is significant upside with arbitrage as well if the deal does go through. So currently, because of inflation and margins, as I stated before, Albertsons starting to look at focusing more on private label here. So that's pretty interesting when we factor that in possible margin expansion, which could also lead to multiple expansion down the future. So I want you guys to remember that as well. So a couple things we have to remember here is, number one, they definitely benefited from the COVID at home. People started grocery shopping more and staying at home. And we saw a big influx in their revenue. Along with that, their margins are not strong which impacts their free cash flow. And so now they're focusing on possibly going more private label, which could impact margins positively and also give them multiple expansion. The free cash flow is kind of all over the place. They were doing roughly $428 million in free cash flow, bumped up to $2.2 billion, $1.9 billion, $700 million. Looking at their quarterly report, we can see that same store sales were up 5.6%. Digital sales increased 16%, so they are hopping on the digital sales, which to me is going to drive top line revenue. So we're seeing strong growth in a business that's actually been substantially discounted since the merger did not go through here. And so now this leads me to, what is a fair price to pay for the stock if I just wanted to own it, knowing that Kroger is still interested in buying it, and that could definitely go through for a nice arbitrage move. And so if I'm just being very conservative and saying that they're going to grow between 3 to 2% over the next 10 years, which I think is extremely doable. EBITDA margins, as I stated in the company, are extremely weak. They average between 3 to 6. I'm using 4, 5, and 7 in the future, as 7 would be. They do start using more private brand labels, which will expand margins down the road, and inflation might not be as big of an issue going forward as well. So I'm using that as kind of an example here. From a free cash flow standpoint, this company does not have good free cash flow margins. That's going to be the normal case when we're dealing with grocery stores. And for most metrics, this company trades at a substantial discount to its peers. As we can see here, a 6 to 7 PE ratio versus industry standard of roughly 18 to 19. Obviously, the higher quality the retailer, the more premium you're going to pay. When we take a look at a company like Walmart, obviously there's going to be a higher premium with that. But with a company like Albertsons here, it could find itself getting margin expansion and multiple expansion, but we're going to use the multiples that they're kind of given. We're going to use the multiples that they currently have right now just to really see where we are as far as fair price to pay for the stock. So from an EV to EBITDA multiple here, looking at a 6 versus 12 industry standard, as once again, it's trading for roughly half the valuation. So if I plug in those really low growth rates and those margin and those very slim margins that we're talking about here, we do get basically between an $18 to $22 stock here. And that's where it gets very interesting, in my opinion, for the company, because even if the acquisition doesn't go through here, I still think you have the ability to get a $40 to $50 stock in the future with the current business model intact as is. So I'd be looking to possibly enter a position in this between $18 and $19, maybe reach a little bit on 20. But I think it's a pretty interesting stock, both from an arbitrage standpoint of the deal going through, or being able to actually get a decent company that trades at a below market multiple. So that's kind of where I'm at with this. I think it's a pretty interesting company, and I think on a decent market pullback here, I would actually like to own some. So let me know what your thoughts are about Albertsons. As always, appreciate your time. Thank you so much for spending it with me, and we will see you in the next one. Peace.